A lot of possibilities still for interest rate path here in the U.S., according to Neil Kashkari. Joining us, Mr. Jeff Kleintop, helping us put central bank perspective around the world. Chief Global Investment Strategist at Charles Schwab. Morning, Mr. Kleintop. Good to see you, Jeff.
Morning. Thanks for having me on, Oliver.
Always. All right, so we got this kind of dollar slide the last few sessions, despite what seems to be such a stark difference in Fed commentary versus rest of central banks. Just kind of curious to get your thoughts on some of that short-term action.
Well, I think the focus of the rhetoric is very much on the near term. We've got 90% plus odds of an ECB rate cut on June 6th. But what happens after that is a lot less certain. And we've gone from pricing in a sure thing of 3 to 4 rate cuts to maybe just 2 or 3. And so over the course of the remainder of this year, so there's 5 meetings, including June. That means they're going to cut it just 2 or 3 of them. So that's pulled back a little bit certainly from the start of the year, but even more so in the last, I should say, in the last month or so. So maybe a tiny bit more hawkish at the margin here for cuts after June 6th. That may be helping to firm up the euro versus the dollar a little bit.
It's a good point because this doesn't necessarily have to be a traditional cycle where once you start cutting, you keep cutting. You know, we've already kind of been in the pause and hold timeline here for the Fed. So I guess that might be a little different this time around.
Yeah, and you're right. It's very non-traditional. In fact, I can't remember a time any G7 central bank started to cut rates and didn't finish with, or didn't continue with cuts at the next 2 or 3 meetings. So to cut and then skip and then cut and then skip is very unusual, but it just shows that nowhere are central bankers really in a hurry to get rates considerably lower from where they are today.
There's also this notion of kind of reflexivity to some degree where, the actual cuts, I mean, in theory, they're supposed to help buoy the economy, kind of give them a lift. And, if things aren't terrible, then to your point, that could firm up those currencies relative to ours if it actually works.
Yeah, so the economic data that we've just gotten with the PMI data last week was pretty good. It continued to show a global economy that's improving, a manufacturing sector that's doing a little bit better, although maybe not as strong as we'd like to see it, and the service sector holding up. So there's not an urgent need here for rate cuts. We're not seeing a broad deterioration in the labor market. Earlier this year, we did see job losses in a couple of economies, like the Canadian economy, for example, but that's actually turned around, and job growth has actually surprised on the upside in a number of economies. So both from a labor and an economic perspective, immediate cuts are not particularly warranted. So rather make sure inflation stays close to target rather than try and boost growth here in the near term. So I think that's the backdrop around all these central banks, and one of the reasons why those expectations out for the remainder of the year have narrowed a little bit.
Okay, let's talk some China here first as we kind of go around the globe. Jeff, market's been beating the U.S. year to date. A little bit of step back last week, but it's been pretty rewarding trade for those betting on the comeback. I hear still a lot of dissent, though, among investors on how sustainable that is. Tell me how you're reading it and what you're watching.
Yeah, so I think the latest move has to do with some of this response to the semiconductor bans that have been put in place in the U.S. And now the U.S. is urging allies like in the Netherlands, who make semiconductor capital equipment, and Korea and Japan, other places, to really tighten up curbs on sending advanced semiconductors to China. But rather than signal more gloom for China's growth outlook, shares of China's major chip stocks really jumped on Monday on news that China set up the largest ever semiconductor investment fund to propel development within China. And so you saw Huawei Semiconductor, which is the largest chip maker in the MSCI China index, was up 11% in Hong Kong trading on Monday. And that really helped boost Chinese stocks, which had slumped in the last 3 days or so, but now are matching the performance of the S&P 500 this year. So we're seeing some of that, the lemons getting turned into lemonade here in terms of China really delivering support to a number of businesses that also show up in the stock market.
And their plan for stimulus or policy support is what at this point, Jeff? How clear is their outlook? Because it always kind of seems I feel like they're the most murky of all the central banks around the world.
Yeah. So in terms of what the People's Bank of China is going to do, it's tough because no one really wants to buy homes because they're concerned they're not going to get those homes built because of the problems with the property developers. So no one really wants to get a loan at any rate. So even cutting interest rates to encourage consumption, consumers have enough income. Their savings rates have actually gone up. They're just unwilling to actually part with any of that money. I think one of the things that's interesting about the yield backdrop is that chart that you have up right now. Chinese and Japanese bond yields are moving in opposite directions. Their 30-year benchmark bond yields are now just 40 basis points apart. This has never happened before in the entire 20-plus year history of Chinese and Japanese government bond issues. They've never touched before, and they're getting close. I think on Friday, when we get the PMI readings for China and the Tokyo CPI inflation readings for Japan, these could actually touch if we continue to see them support these trends. China's got this downturn in the property market, resulting in sluggish consumer spending. Japan is seeing real wage growth for the first time in a very long time, lifting consumer spending. So again, that data on Friday could actually close this gap even further. And that, to me, is interesting because it could support the yen, which could be a further boost here to U.S. investors investing in Japanese equities.
So it seems like generally things still point towards a pretty strong case for being invested in Asian equities, being invested in global equities too. But it sounds like Japan and China, basically what has led their markets to outperform so far, is largely still continuing. The momentum's still there.
I think in Japan that is the case. It's been masked a little bit by this yen weakness. I think that'll turn around in the second half. I think the Bank of Japan is probably going to hike another 2 times this year, and so that should help support the yen. In China, I'm not so sure. They are rolling out domestic stimulus and support programs and semiconductors, a few other areas, but it's not organic. And the problem is the economy is still suffering from consumer spending pullback. So again, I don't think that's sustainable, but what does show that the Chinese stock market probably has put in a low at a single digit PE. It's probably hard to get to push it down any lower. That doesn't mean the rally is sustainable though.
At the risk of reducing it to like a simpleton analysis, though, the Japanese trade seems to have benefited from higher rates there. It seems like the only real market where watching their bond yield go up has been a good thing. Is that fair to say, like just kind of 1-to-1?
Yeah, exactly. I mean, usually that's not something that's favorable for the equity market in many cases, but because we're coming from such a low level, higher 30-year yield suggests better growth and higher inflation, at least inflation above zero, which is something that Japan's wanted for some time to stimulate consumption, right? If you think prices are going to go up in the future, you're more likely to buy today, as opposed to if you think prices are going to go down, you delay consumption. It's been a problem in Japan for a while. Both of those seem to be on the mend. That's why stocks are reacting favorably to higher yields.
Got it. Okay. Now, also on your calendar, Jeff, on the international front, some elections. Walk me through the calendar. What's important and where are you going?
Yeah, I could go on this for a while, but I'll be short about it. Mexico's elections are coming this weekend on June 2nd, and the following week are the EU parliamentary elections from June 6th to the 9th. By the way, June 6th, ECB date they're expected to cut. So cutting literally at the start of the elections. That'll be interesting. In Mexico, here's the deal. The winner of the Mexican election, the 2 women that are leading in the polls, have very different views on a number of policies. But the key thing is that the U.S. Canada-Mexico trade agreement is up for review under the term of this next president. This is a very different environment for trade than we were looking at back in 2018. And so signals from Mexico's new president, whoever that turns out to be in a week from now, around the renewal of that USMCA, if they're somewhat skeptical about that, that could really complicate investment planning and business planning in US's biggest trading partner. So that's a potential risk here we're going to have to keep an eye on in the next week or so. And then, of course, that June 6th election kicking off in Europe. There's a My Country First approach among many of the leading parties in Europe right now, including Germany's AfD, which is polling in second place, Marine Le Pen's National Rally Party, ahead of President Emmanuel Macron's Renaissance Party in opinion polls, all that pointing to more trade barriers and protectionism. So again, something we'll need to watch here in terms of the global companies that populate the S&P 500 and many other indices around the world. All
right. Always helpful, always also new information, novel information that I wouldn't have known otherwise. Thank you very much, Jeff Kleintop. Appreciate that.
Thanks, Oliver.
All right. Good reminder, too, of what's been working for international equities, which are beating U.S. on the year. Thanks, Mr. Kleintop.